Hi, my name is Roger Schlitter. This video is actually about the bank's most important ratio when they're looking at business loans. That ratio is the debt coverage ratio, and it's really called the official name. I guess is the debt service coverage ratio, but most people just call it the debt coverage ratio. So anyway, debt coverage ratio is abbreviated DCR. Is the most important ratio for a bank in approving a business loan. This ratio measures the amount of cash flow that the company has to cover their debt service requirements in 1 year. The equation actually is DCR, debt coverage ratio, equals net operating income divided by total debt service. So anyway, the net operating income is the revenue or sales minus the operating expenses, really all the expenses, if you're dividing operating separate from other expenses. So anyway, it's the net operating income is the revenue or sales minus all the expenses. Debt service is the total debt service, including principal, interest, lease payments, etc. There are several ways to determine the net operating income or the debt service, but this is the simplest way to determine the debt coverage ratio. Just use your net income, and then go ahead and take all the debt and take your income divided by the total debt. The debt coverage ratio tells the bank if your cash flow can cover your debt expenses. You at least want them to cover it a 1-to-1. So the minimum, obviously, is over 1.0. The higher your company can cover your debt with your cash flow, the better the ratio is. SBA probably has a pretty low bar for debt coverage ratios, and the lowest for SBA is a 1.1. Has to be a 1.1 or higher, or SBA is not going to do it. Banks will want your company's debt coverage ratio to be at least a 1.2 to a 1.3, and a lot of them say 1.25 to 1.3 or 1.35, and the higher the better for your ratio. Highly indebted companies usually have like a lower, like a 1.15 to a 1.20, but really the norm is the 1.2 to a 1.3 debt coverage ratio. And the higher the better. So if you have a 2.5 or a 2.3, that is great. 2.35, that's great. If you have a 2.0, that's fabulous. If you have a 3.0, that's even better. So anyway, don't hold yourself to those very small coverage numbers. I mean, if it's going to be larger, or if you're projecting it to be larger, I would put the larger number. Both the net operating income and the debt service are measured obviously in 1 year. I cannot stress enough the importance of this ratio to banks and SBA when analyzing a business loan. Basically, when a bank or when SBA looks at a business loan, this is one of the main things. The debt coverage ratio is one of the main things they really look at. They're cash flow lenders, and they want to make sure that the cash flow covers the debt and there's money left over, either for profit or for other things, reinvestment in the business, whatever. So anyway, if you had to show the most important ratio for a business loan, it would be the debt coverage ratio, hands down. Using the debt coverage ratio is more than an art. So if you have a number that's low, or if you have something that doesn't quite make sense, you want to really try to bolster that the best way you can. Do that in your write-up, do that in your numbers and your projections. To show maybe it's got a low debt service coverage ratio starting out, in the first year, but you can improve that in the second, third, and fourth year. So anyway, thank you for watching. I really do appreciate it. Hope you hit the subscribe button and hit the notification bell for notification of future videos. If you really got something out of this, I hope you hit the like button. And my name is Roger Schlitter, and I will see you in the next video.